Hello, I'm Professor Brian Boucher. Welcome to the first video in An Introduction to Financial Accounting. What we're going to do in this video is first provide an overview of the financial reporting landscape. What's required in financial reporting, who makes the rules, who enforces the rules, and then second, we're going to look at an extended example of what the financial statements can tell us, which will introduce some concepts that we'll see again and again throughout the course. I hope you enjoy the video. Let's start with a definition. Accounting is a system for recording information about business transactions to provide summary statements of a company's financial position and performance to users who require such information.
Wow, please tell me the whole video won't be this boring.
I hope not, but to spice things up a little bit, I will bring in some virtual students to ask questions or make pithy comments every now and then. Anyway, this definition has three parts. The first part is recording transactions. This part turns out to be a big deal as not everything a business does gets recorded in the financial statements, and sometimes it will seem like nothing's happening, yet we'll need to record a transaction anyway. The second part is about providing summary statements. Large companies have billions and billions of transactions each year. If they made them all available to you in a gigantic database, your first question would be, how can I summarize all of this into one or two summary numbers? And the third part focuses on users, as different user groups would want different types of summary numbers. So most companies keep at least 3 sets of books. Our focus in this course will be financial accounting, the standardized set of statements geared towards external users such as investors, creditors, customers, suppliers, competitors, and any other stakeholder. However, these financial statements are not used to determine taxes. There's a separate set of books based on tax rules to compute how much taxes a company has to pay. These rules are often quite different from what we do in the financial statements. Finally, there's managerial accounting, which provides customized reports for internal decision making. We won't cover this topic in this course, but you should be aware that the financial accounting we do cover is generally not used for internal decision making. So what are the financial reporting requirements? The Securities and Exchange Commission, or SEC, requires periodic financial statement filings. Companies must file an annual report, or 10-K, once a year. This includes the full set of financial statements with a substantial amount of additional disclosure, generally running 200 to 300 pages. The other 3/4 of the year, firms must file a quarterly report, or 10-Q, which is also a full set of financial statements, but less required disclosure than in the annual report. If anything material happens between quarter ends, companies must file an 8-K or current report. Material information is generally viewed as anything important enough to move stock price, which means companies file these quite often. They don't require the financials, just an update on whatever major corporate event has occurred. All of these filings have to be prepared in accordance with generally accepted accounting principles, or GAAP.
Excuse me. Does this stuff only apply to US companies?
That's a really good question. I should note at this point that this course will be very US-centric because I am at a US business school. However, almost everything we cover is going to be applicable globally. So for example, even though I just gave you SEC filing requirements in the US, every country in the world that has a securities market also has filing requirements like an annual report. The only difference that you might see internationally is instead of a quarterly report, some countries have semi-annual reports. Also, none of this applies to private companies formally, but if a private company goes and borrows money from a bank, banks are so used to seeing reporting come in this kind of frequency that invariably private companies will produce annual statements and some kind of quarterly or semi-annual statement in addition. So this is a pretty universal set of financial reporting requirements. These periodic filing requirements create much of the tension in financial accounting that we're going to have to deal with in this course. For example, let's say you ship goods to a customer in one quarter but collect the cash in the next quarter. When does the sale occur? Or let's say you buy equipment in one quarter and then use it for the next 23 quarters. When does the expense occur? A lot of what we need to do is figure out what quarter to put these various business activities into. So who makes the rules? Generally accepted accounting principles, or GAAP, are established by the US Congress. But they're generally too busy doing things like investigating steroids in baseball or trying to figure out what's going on at the IRS that they don't have time to do accounting standards. So they delegate to the Securities and Exchange Commission. But they're often too busy trying to catch the bad guys that they don't have time to make the rules, so they delegate to the Financial Accounting Standards Board, or FASB, a 7-person board in Norwalk, Connecticut that has the authority to make accounting rules in the US. Now, sometimes they're even too busy to make all the rules, and so there's an Emerging Issues Task Force, or the AICPA, that can also have a hand in making accounting rules. That's just in the US. Internationally, there's International Financial Reporting Standards, or IFRS, that are established by the IASB, or International Accounting Standards Board, and are now required in over 70 countries, including the EU. But as of now, US GAAP is still required for US firms. So there's basically 2 big sets of standards out there in the world. But the good news is, for almost all of the intro accounting topics, there's a really high degree of overlap in the 2 standards.
Why doesn't the US just switch to IFRS? Do you think there will ever be one global accounting standard?
Actually, in the summer of 2008, the SEC came out with a roadmap to move US firms to IFRS by the middle of this decade. But then Lehman Brothers went bankrupt, the financial crisis hit, and this thing dropped way off of the SEC's radar screen. So for the foreseeable future, we will have 2 sets of standards in the world, US GAAP and IFRS. Although, as I mentioned earlier, the 2 standards are becoming closer to each other. The FASB and the IASB have been working together on any new standards. And so even though there are 2 standards, just about everything we talk about here in US GAAP would also be applicable under IFRS. So who's responsible for financial reporting? Management is responsible for preparing their own financial statements.
Wait. What? That is like a professor allowing students to give themselves their own grade. Everyone gets an A+.
Yes, that's correct. We allow managers to prepare their own financial statements because they have the most information about what happened at the company. And we hope that they use whatever discretion they have in financial reporting to better communicate their activities. But we do recognize that they may use this discretion to try to manipulate or obfuscate or be opportunistic in how they report. So there are a number of checks and balances that are there to try to curb managers' opportunistic behavior. First, the Audit Committee of the Board of Directors provides oversight of management's accounting process. However, this is not a foolproof check on managers' opportunistic behavior. One of the biggest financial statement frauds ever was Enron, and the head of their audit committee was a guy whose full-time job was accounting professor, which means you could put someone like me on the board and still have these kinds of problems. So then, auditors are hired by the board to express an opinion about whether the statements are prepared in conformity with GAAP. Again, this is not a foolproof check against managers being opportunistic. In the case of Enron, their auditor, Arthur Anderson, signed off on some of the more aggressive things they did, and a lot of it was because they were being hired by the company, and Enron was their biggest client in Houston. If they lost Enron, they would have had to go to the second biggest company in Houston, which is... Exactly, who knows what the second biggest company in Houston is, and that's why they wanted to keep Enron. The next line of defense is that the SEC and other regulators will take action against the firm if any violations of GAAP or other rules are found. Now, these bodies tend to be very reactive instead of proactive, and it's really after someone else has brought the fraud to their attention that they most often then launch an investigation. So by and large, it's information intermediaries like stock analysts, institutional investors, and the media which provide the biggest check on managers' behavior by either exposing or fleeing firms with questionable accounting. But again, by the time one of these parties gets involved, it's very public what is happening, and the stock price drops, and you're in bad shape if you were an investor. So the only people that are going to really look out for your interest in terms of making sure the financial reporting is high quality is you, which is why it's really important that you learn some basics in terms of reading financial statements. Next, what are the required financial statements? There's 4 of them. First, there's a balance sheet, which gives the firm's financial position, its listing of resource and obligations on a specific date. Then there's an income statement, which provides results of operations over a period of time using accrual accounting. In this case, as we'll talk about, recognition is tied to business activities, not cash coming in or out. For that, there's a statement of cash flows, which gives sources and uses of cash over a period of time. And then the last statement is the statement of stockholders' equity, which provides changes in stockholders' equity over a period of time.
Okay. Could we get an example? This is pretty abstract.
Yes, in fact, we'll go through an extended example right now where we'll look at a very simple business and see how the different financial statements can capture what's going on with that business. And since you're probably getting sick of my voice at this point, I'm going to turn it over to a narrator to give you the facts of the example.
Dave starts a business to transport expensive cars. On December 1, 2012, he receives $50,000 cash from issuing common stock. He also borrows $80,000 from a bank and buys a $100,000 truck. It will be used for 48 months, with a $4,000 salvage value.
Excuse me, Mr. Narrator. What is salvage value?
We will explain that later. Dave also pays $12,000 cash up front to rent office space for 1 year. During the month of December, Dave's company moves 2 cars. The clients will pay Dave $40,000 within 30 days. Dave also pays his employees $10,000 of wages. On December 31st, the bank wants to see financial statements.
The bank wants to see financial statements because they want an answer to the question, did the company make money during December? Well, there's a number of different ways that we could try to provide evidence on whether the company made money or not. First way would be to just look at cash flows. So if we take the facts, we got $50,000 from issuing stock, $80,000 from borrowing from a bank. We paid $100,000 to buy a truck. We paid rent. We paid wages. We didn't get anything from customers. And so we ended the month with $8,000 cash. As it turns out, this is a really bad way to try to figure out whether the company has made money or not.
Pardon me. What is wrong with that? Anytime I end the month with cash in the bank, it is a great month.
Well, this is actually how a teenager would do accounting. You get an allowance from your parents, you borrow some money from your parents, you spend a bunch of money. If you have money in the bank at the end of the month, it was a great month. But it doesn't work so well for companies, because all a company would have to do to post better performance would be to borrow more money or raise more stock. So a better way to look at cash flows would be to separate them into whether they came from running the business, investing in the long term, or financing the business. So for instance, our operating cash flows would be we paid money for rent, we paid money for wages, we didn't get anything from customers, and so our operations actually had a net outflow of cash of $22,000 during the month. In terms of investing for the future, we bought a $100,000 truck, which now we can use for 4 years. That's our cash flow from investing activities. And for financing the business, we raised $50,000 from issuing common stock, and we borrowed $80,000 from a bank, giving us $130,000 cash inflow from financing activities. So this cash flow statement divides up the cash flows based on their source. Did they come from operating? Did they come from investing? Did they come from financing? Gives us the same bottom line of $8,000 change in cash. So this is what the statement of cash flows is going to look like. It's going to report cash transactions over a period of time, split into whether they're operating, related to providing goods or services or other normal business activities, investing, related to acquiring or disposing of long-lived productive assets, or financing, which are transactions related to our owners or creditors. Another way to try to answer the question of whether the company made money during December is to look at accounting income. Accounting income tries to look at business activities rather than just cash coming in or going out. For example, we actually moved 2 cars during December. Even though we haven't gotten paid cash yet, we're likely to get paid cash, and so why not book revenue of $40,000, recognize that we're going to eventually get cash coming in from doing the business activity. With the truck, we paid $100,000 cash this period, but we're going to use it over 4 years. So why not allocate that cost over the period of time that we use the truck? For instance, $100,000 truck, salvage value of $4,000 is going to be what it's worth when we're done with it, so we're going to use up $96,000 of value over 48 months, we're using up $2,000 worth of the truck based on moving the cars this month. With the rent, we paid $12,000 cash up front, but that was for a year. We've only occupied the space for 1 month, so why not just recognize 1/12 or $1,000 as the cost of rent? All $10,000 we paid to employees was earned this month, and so we recognize that as an expense. And so we come up with a number called net income, which is a measure of, did we price our service, in this case moving cars, did we price our service high enough to cover all the costs of running the business this period, all the cost of moving those cars? And what net income tells you is, yeah, we did price our product or service high enough to cover all of those costs. This is what the income statement is going to show us. It's going to report the results of operations over a period of time using something called accrual accounting. And we'll obviously talk about this a lot more as the course goes along. But in this case, the recognition is tied to business activities, where we have revenues which are going to be increases in something called owner's equity, not necessarily cash from providing goods or services. Expenses are going to be decreases in owner's equity incurred in the process of generating these revenues, again, not necessarily cash. And so we end up with net income, which is also called earnings or net profit, equal to these revenues minus expenses, gives you a different picture than simply the change in cash.
This does not make any sense. How can we record revenue without getting any cash? What is this depreciation stuff? We didn't spend $2,000 on a truck, we spent $100,000.
Okay, just give me a few videos. It'll take a little bit for me to explain this to you. Hang in there.
Fine. So there are two different statements for this month's results. Which one is better? Which should we use?
I once heard that cash is king. I am going to only use the cash flow statement.
No. We'll talk about this more, but you definitely want to use both statements because they're giving you two different pictures of what happened at the company. For instance, revenue tells you how much you're going to get from customers based on actually moving cars, and the cash flow for customers tells you how much cash you got this period. For the truck, the cash flow tells you how much cash you spent to acquire the truck. The accounting income tells you how much of that truck was used this period. Rent expense. The cash flow tells you how much cash you spent for rent. The rent expense tells you how much was actually used up this month. Sometimes the cash flow and the expense are the same, but you're really getting two different pictures. Cash flow from operations, negative $22,000, says this month you actually spent more cash than you had come in. But net income said that you actually priced your product enough to cover all the costs of delivering it, which even though it didn't get you cash now, is going to lead to cash flow in the future. So just to hang with me for a few more videos, and hopefully this will all make sense. We've got one more statement to do, and that's answering the question of what is the financial position at the end of the month. And here we're going to look at the balance sheet. So remember, this is the listing of all the resources and obligations of the company. So resources we call assets. So we have cash of $8,000. That's cash in the bank at the end of the month. Accounts receivable of $40,000. This is the cash that's owed to us by the customers whose cars we moved. It's an asset because it's going to turn into cash. Either we're going to collect it from the customers, or we could securitize it through a special purpose entity and get the cash immediately, which is sort of beyond the scope of what we're doing here. Prepaid rent is an asset. We paid 12 months in advance for rent. We've used up one of those months, but we still have prepaid 11 months of future space at the end of the month. That's an asset. The truck is an asset. That's something that we can use to run the business for the next 47 months. So we have a total of $157,000 of assets. And then we look at all the obligations. These are the liabilities and stockholders' equity. So we owe $80,000 to the bank at the end of the month. That's a liability called bank debt. We got $50,000 of shareholder investment. That's the shareholders' claims on the assets. That's part of our obligation to our shareholders, common stock of $50,000. And then we have something called retained earnings, which is how much accounting net income that we've recognized, less any dividends that we've paid out at the end of the month. And these are all the obligations against the resources of the company.
I am truly lost. When is this video going to end?
I'm sorry, I know I've thrown a lot at you in this video, but just keep in mind that everything we've talked about, we're going to talk about again in more detail. So just hang in there. Let me go through a couple more slides and then we'll wrap this up. So as I was saying, this financial statement is called the balance sheet, which reports a financial position, the resources and obligations on a specific date, split up into assets, which are resources owned by a business expected to provide future economic benefits, liabilities, which are claims on assets by creditors, non-owners, that represent an obligation to make future payment of cash, goods, or services, and stockholders' equity or owner's equity, which are claims on the assets by the owners of the business, come from two sources: contributed capital, which is when we sell shares, and retained earnings, which arise from operations. And again, we're going to go through all of these in much more detail in the next videos. The last statement is the statement of stockholders' equity. We're going to get to this later. Hopefully that gave you a good overview of what we're trying to accomplish with financial reporting. Now we're going to dive into all of these concepts in more detail, starting with the balance sheet. I'll see you next video.
See you next video.